Silver just gave every investor a warning. Gold, platinum, and palladium all fell the same day. And one number from Washington may explain exactly why. If you have been asking whether the summer rally in silver is finally over, this is the video you need to watch. Welcome back to Currency Arc Insight, the channel built for investors, entrepreneurs, and wealth-conscious viewers who want to understand where the real money is moving before the headlines that catch up. Today, we are breaking down a sudden pullback across the entire precious metals complex, what the latest inflation data is really telling us, and whether silver has already seen its high point for the summer season. Across the precious metals market, a single trading session delivered a message that serious investors could not afford to ignore. Silver, gold, platinum, and palladium all moved lower on the same day, a rare alignment that signaled something larger than an isolated dip in one metal. When every major precious metal falls together, it points to a shared macroeconomic trigger, rather than a coincidence confined to a single market. Palladium bore the sharpest decline of the session, falling more than 4% and shedding $55 in value. The metal touched a session low before stabilizing, but the scale of the move stood out even against a broader retreat across the sector. Palladium's sensitivity to shifts in industrial demand and monetary policy expectations makes it one of the more volatile members of the metals complex, and this session reinforced that reputation. Gold, often viewed as the anchor of the precious metals space, declined by more than 1%, slipping below the $4,400 mark after reaching a fresh peak just one day earlier. The reversal was notable not because of its size, but because of its timing. Gold had been building momentum into the release of new economic data, and the pullback suggested that traders were repositioning quickly once that data arrived. Platinum followed a similar path, falling more than 2% and giving back nearly $40 in a single day. Like palladium, platinum carries meaningful exposure to industrial and manufacturing demand, which ties its price action closely to broader economic signals rather than to safe haven behavior alone. Silver, the focus of ongoing attention from investors watching this year's rally, told its own story within the broader decline. The metal touched a session low before recovering some ground, though it fell short of matching the prior day's highs. This pattern, an early push higher followed by a retreat as new data hit the market, has become a recurring theme in silver's recent trading behavior. It illustrates a market caught between strong underlying demand and short-term sensitivity to economic releases. What makes this pullback significant is not simply the size of the moves, but the fact that they happened in unison. Gold, silver, platinum, and palladium each respond to slightly different demand drivers. Gold reacts most strongly to monetary policy and currency strength. Silver splits its identity between monetary demand and industrial use. Platinum and palladium lean more heavily on industrial and automotive demand. When all four decline together, it suggests that a single powerful force, in this case new inflation data from Washington, temporarily overrode each metal's individual demand story. For investors, this kind of synchronized movement carries an important lesson. It confirms that precious metals prices in the current environment are being driven less by supply and demand fundamentals in the short term, and more by shifting expectations around interest rates and inflation. Understanding this distinction is critical for anyone trying to separate short-term noise from the longer-term structural case for owning gold and silver. This session also served as a reminder that even a strong multi-month rally does not move in a straight line. Pullbacks like this one are a normal part of any sustained bull market, particularly one built on macroeconomic uncertainty rather than a single catalyst. The question now facing investors is not whether this pullback is meaningful on its own, but what it reveals about the data behind it, and what that data suggests for the direction of silver and gold as the summer season moves toward its final stretch. In the next section, this analysis turns directly to that data, examining what the latest inflation report revealed, why it came in weaker than expected, and why that outcome, paired with a resilient labor market, has created one of the more unusual economic backdrops investors have faced this year. To understand why silver, gold, platinum, and palladium all pulled back together, investors need to look directly at the economic data released that same day. At the center of the move was the Producer Price Index, a measure that tracks the prices businesses receive for the goods and services they sell, and one of the most closely watched inflation indicators available to the Federal Reserve. The reading came in below what economists had anticipated, showing a slowdown in year-over-year growth. On the surface, this looked like encouraging news. Slower price growth at the producer level typically signals that inflationary pressure throughout the broader economy may be easing, which is generally viewed as a stabilizing development for markets. But for precious metals specifically, weaker inflation data creates a more complicated picture than it does for stocks or bonds. Gold and silver do not simply rise when inflation is high and fall when inflation is low. Their price behavior is tied more directly to expectations about what the Federal Reserve will do in response to inflation data. When inflation cools faster than expected, it can reduce the perceived urgency for the central bank to raise interest rates. In theory, that should be a positive signal for precious metals, since lower interest rates reduce the opportunity cost of holding assets that do not generate income, like gold and silver. Yet, on this occasion, metals moved in the opposite direction, falling rather than rising on the softer inflation print. This is where the second half of the data becomes essential. While inflation numbers came in soft, the labor market told a different story. Initial claims for unemployment benefits, an indicator of how many people are newly filing for jobless benefits, had recently touched some of the lowest levels seen in decades before, ticking modestly higher. Even with that increase, the underlying labor market remained resilient. This combination, a labor market that refuses to weaken paired with inflation that is cooling, creates a genuinely unusual economic backdrop. For the Federal Reserve, this mix complicates the policy outlook. A weakening labor market alongside falling inflation would typically build a strong case for interest rate cuts, but a labor market that stays firm gives policymakers less pressure to ease. Investors interpreting this data appear to have concluded that the case for near-term rate cuts is murkier than it looked just days earlier, and that uncertainty temporarily weighed on precious metals even as the inflation figures themselves looked favorable. There's also a deeper, more structural dynamic playing out beneath the daily headlines. Since the release of this data, other economic pressures have continued to build, particularly rising fuel costs and higher oil prices, which tend to feed back into future inflation readings. This creates a real possibility that the current soft inflation print may not hold. If inflation ticks back upward in the next report, especially due to energy costs working their way through the broader economy, that could shift the entire narrative again, this time in a direction that adds renewed pressure on the Federal Reserve to act. This is precisely why experienced investors are cautious about reacting to any single data point in isolation. A soft inflation reading in 1 month does not guarantee a trend. Markets are constantly weighing not just where inflation is today, but where it is likely headed over the next several reports. The reaction seen across gold, silver, platinum, and palladium reflects that forward-looking uncertainty as much as it reflects the headline number itself. For anyone building a long-term position in precious metals, this section of the analysis carries an important takeaway. Short-term price swings driven by a single data release are not necessarily a signal about the underlying strength of the bull case for gold and silver. They are instead a reflection of how sensitive markets have become to every incremental shift in Federal Reserve expectations. Understanding that distinction is what separates reactive trading from strategic, long-term positioning. With the inflation picture now in view, the next question becomes how these numbers are actually reshaping expectations for the Federal Reserve's upcoming meetings, and what that shift means for the direction of interest rates heading into the final stretch of the year. If there is one force that moves precious metals prices more than any single economic report, it is the market's evolving expectation of what the Federal Reserve will do next. And in the days following this latest round of inflation and jobs data, those expectations shifted in a meaningful way, offering investors a clearer picture of how the rest of the year may unfold for interest rates and by extension for gold and silver. Markets track these expectations through futures contracts tied directly to the Federal Reserve's benchmark interest rate. These contracts are not guesses. They represent real money being positioned by traders and institutions based on the most current available data, which makes them one of the most reliable windows into how the broader market is actually pricing future policy decisions. In the immediate aftermath of the inflation data, the probability that the Federal Reserve would leave interest rates unchanged at its next meeting rose noticeably. Just a day earlier, the odds had been much closer to a coin flip. After the new data arrived, the balance shifted meaningfully in favor of a hold, with roughly 2/3 of market participants now expecting no change at the upcoming meeting. That is a significant move in a very short window of time, and it reflects just how sensitive rate expectations have become to each new economic release. Looking further out, the picture becomes more nuanced. For the meeting following that one, expectations remain almost evenly split between holding rates steady and implementing another quarter-point increase. This kind of near 50-50 positioning tells investors that the market itself is genuinely uncertain about the path forward, not confidently leaning in either direction. That uncertainty is important context, because markets tend to react more sharply to data when the outcome is not already priced in with confidence. Even further out, toward the final Federal Reserve meeting of the year, current positioning suggests that if a rate increase is going to happen at all this year, this later meeting is viewed as the most likely point for it to occur. That timing matters. It suggests that if the Federal Reserve does decide the current data trend does not hold, and inflation begins re-accelerating as fuel and energy costs feed through the economy, policymakers may choose to wait for additional confirmation before acting, rather than moving at the very next opportunity. For gold and silver investors specifically, this shifting probability landscape is not just background noise. It is one of the primary mechanisms driving short-term price action in the metals complex. Lower interest rate expectations generally support higher gold and silver prices because holding non-yielding assets becomes relatively more attractive when the return available from cash and bonds is expected to shrink. Conversely, when the market begins pricing in a higher likelihood of a rate increase, gold and silver often face short-term headwinds, even if the long-term structural case for owning them remains unchanged. This is exactly why the pullback described earlier in this analysis unfolded the way it did. Even though the odds shifted toward fewer rate hikes overall, the uncertainty surrounding the timing and the resilience of the labor market underneath it created enough ambiguity to trigger a wave of short-term repositioning across the entire metals complex. There's also a broader lesson here for anyone trying to understand precious metals as a long-term holding rather than a short-term trade. These rate expectations will continue shifting, meeting by meeting, data release by data release, for the remainder of the year. Trying to perfectly time entries around each of these shifts is difficult even for professional traders. What matters more for long-term investors is understanding the overall direction of travel. And right now, that direction still points toward an eventual easing cycle, even if the exact timing remains contested. With interest rate expectations now in view, the next piece of the puzzle involves the bond market, the US dollar, and oil prices. Three forces that are all currently moving in ways that do not match their usual historical relationship with gold and silver. That unusual alignment is the subject of the next section. Beyond interest rate expectations, three other markets offer investors a deeper window into what is really happening beneath the surface of this pullback: inflation-protected bond yields, the US dollar, and oil prices. Each of these typically moves in a well-understood relationship with gold and silver. In this particular stretch, however, that relationship has behaved in ways that deserve close attention. Start with bond yields, specifically the yields on inflation-protected government bonds. These instruments are designed to preserve purchasing power against inflation, and their yields represent what investors can earn after accounting for expected price increases. Historically, gold has moved in the opposite direction of these real yields. When real yields fall, gold becomes more attractive, because the opportunity cost of holding a non-yielding asset like gold shrinks. When real yields rise, gold typically loses some of its appeal, because investors can earn a more attractive guaranteed return elsewhere. In the period following this data release, inflation-protected yields moved lower, under the historical pattern that decline should have provided direct support for gold and silver prices. Yet metals fell anyway. This divergence is worth sitting with, because it tells investors that something other than the usual real yield relationship was driving price action that day. It is a reminder that no single relationship, however reliable historically, dictates precious metals prices in isolation. Multiple forces are always competing for influence at the same time. It is also worth noting that this real yield relationship itself was disrupted in a major way during the post-pandemic inflation surge of the early 2020s, when inflation rose so sharply and unpredictably that the normal correlation between real yields and gold broke down entirely for an extended stretch. That history matters here because it shows investors that these relationships are not fixed laws of the market. They can weaken, disappear, or reassert themselves depending on the broader macroeconomic environment. And right now, the signal suggests that relationship may be in the process of reasserting itself, even if imperfectly. Next is the US dollar, measured against a basket of the world's other major currencies. Traditionally, gold and the dollar move in opposite directions. A weaker dollar makes gold cheaper for buyers holding other currencies, which tends to support demand and push prices higher. A stronger dollar has the opposite effect. In this case, the dollar held essentially flat, sitting modestly below its highs from earlier in the summer. A flat dollar does not explain a synchronized decline across the entire metals complex, which again points investors back toward the earlier explanation, interest rate expectations, as the more dominant force in play. Finally, there is oil. Oil prices declined on the same day that gold and silver fell, a combination that runs against the more typical historical pattern. Energy prices and precious metals often move together during periods of rising inflation concern, since higher oil prices tend to feed directly into broader inflation expectations, which in turn can support gold as a hedge. Seeing oil and metals decline together, rather than diverging, reinforces the idea that this was a demand and expectations-driven pullback rather than a fundamentals-driven one. Investors were not reacting to a change in the physical supply and demand picture for gold, silver, platinum, or palladium. They were reacting to a rapidly shifting interpretation of what the Federal Reserve is likely to do next. Taken together, these three signals, falling real yields, a flat dollar, and falling oil, paint a picture of a market temporarily out of sync with its usual internal logic. Analysts covering the bond and currency markets have pointed to continued expectations that inflation will gradually moderate, allowing the Federal Reserve to hold rates steady before eventually easing further down the road. That broader expectation remains supportive for gold and silver over time, even if it did not prevent a short-term pullback driven by uncertainty around the exact timing of the next move. For investors, the lesson from this section is one of patience and perspective. Short-term divergences between precious metals and their traditional macro relationships are not unusual, particularly during periods of shifting Federal Reserve expectations. What matters far more is whether the underlying structural forces, inflation trends, real yields, and dollar strength continue moving in a direction that favors gold and silver over the coming months. With bonds, the dollar, and oil now in view, the analysis turns to the central question investors have been waiting for. Has silver already seen its high point for the summer, and what would it take for that outlook to change? Every piece of this analysis has been building toward a single question that investors watching silver this season most want answered. Has the metal already reached its high point for the summer, or is there still room to run before the season closes out? The case for a summer top begins with the price action itself. Silver's recent high sits in the mid-$60 range, a level the metal touched but was unable to hold as new inflation and jobs data reshaped Federal Reserve expectations in the days that followed. Since that high was set, silver has pulled back alongside the broader metals complex, and the forces now in play, firmer odds of a Federal Reserve hold, a resilient labor market, and short-term repositioning around rate expectations, all point toward a market that may be pausing rather than pushing higher in the immediate term. There's also a calendar-based argument supporting this view. The next major pieces of economic data, the following Producer Price Index and Consumer Price Index reports, are not due for roughly a month. Markets tend to trade in a narrower, more directionless range during these data gaps, as traders wait for fresh information before committing to a new trend. Without a new catalyst, whether from inflation surprising to the upside, a shift in labor market conditions, or a geopolitical shock, silver may simply lack the fuel needed to break meaningfully above its recent high before summer gives way to fall. That said, investors should be careful not to mistake a pause for a permanent ceiling. The structural case for silver has not changed. Silver continues to benefit from a combination of monetary demand tied to inflation and interest rate expectations, and industrial demand tied to its role in electronics, solar technology, and broader manufacturing. Neither of those demand drivers has weakened. What has shifted is short-term sentiment around the timing of Federal Reserve policy, not the underlying fundamentals that built this year's rally in the first place. It is also worth acknowledging real uncertainty sitting just beneath the surface of the current inflation data. Rising fuel and energy costs since the most recent reports could easily feed into the next round of inflation readings, pushing prices higher rather than continuing the cooling trend markets have been pricing in. If that happens, it would materially change the Federal Reserve conversation, and with it, the outlook for silver. A hotter than expected inflation print in the coming weeks could just as easily reignite momentum as it could apply further pressure, depending on how markets interpret the Federal Reserve's likely response. This is precisely why experienced investors resist the urge to declare a definitive top or bottom in real time. Markets rarely move in straight lines, and precious metals in particular are prone to sharp, short-term reversals that can look decisive in the moment, but ultimately prove to be pauses within a larger trend. What matters more than predicting the exact high of the season is understanding the conditions that would need to change for that trend to shift meaningfully in either direction. For now, the evidence suggests silver may be entering a consolidation phase, a period of digestion following a strong multi-month advance, rather than the start of a sustained decline. The next real test arrives with the September data releases, when investors will find out whether cooling inflation was a temporary blip or the beginning of a more durable trend, and whether the Federal Reserve's cautious positioning holds or shifts under renewed pressure. Until then, the message for investors is one of discipline rather than urgency. Watching the data, understanding how each report reshapes Federal Reserve expectations, and recognizing the difference between short-term noise and long-term structural demand will matter far more than trying to call the exact top or bottom of any single trading range. Silver's story this summer is not over. It is simply entering its next chapter, and the data arriving in September will determine how that chapter unfolds. That closes out the 5-part script for this episode of Currency Arc Insight.